I frequently get asked, what is the first step you should do when you want to buy a house? And the answer is super simple: financing. You have to figure out what you can afford. You got to figure out what type of loan you can approve for, how much you can approve for, and you're probably going to want to find out how much your monthly payment's going to be and how much your out of pocket's going to be. So, where do you start? How do you know who to call? Well, the best thing you can do is ask a real estate agent or a realtor, because we have worked with a lot of different ones and we start to get a feel for who knows what they're doing and who doesn't, and who's going to have a smooth transaction and keep it easy for our customers and our clients. So the best thing you can do is reach out to a realtor that you know. Word of mouth is great to find a good realtor. If you don't have anyone to talk to about finding a realtor, you can ask me and I'll find out for you. I'll find one. So ask a realtor for a good lender. Reach out to that lender. There's no strings attached. You are just on a fact-finding mission at this point. You can either apply with them online. Most lenders have a link that you can click and fill out in the comfort of your own home. You can call them. They can take your application over the phone. You can text a lot of them, or you can just simply call them and say, listen, I don't know what I'm doing. I want to buy a house. Can you tell me where to start as far as like how much I'd be able to afford? And they can talk you through it. But I know that a lot of my clients, the first thing that they're worried about is, how much is it going to cost me to buy a house? Well, I'm here to give you a real life example. This is a house in York, Pennsylvania. It sold for $280,000, and the client used an FHA loan. An FHA loan is just a government-backed loan. FHA does not stand for first-time home buyer. It stands for Federal Housing Authority, and it just simply means that the government is backing your loan. They needed to put a down payment of 3.5% down. That's standard with an FHA loan. So on a $280,000 house, the down payment was $9,800. And then on top of your down payment, you have a series of other closing costs. So I always tell everyone, yes, it's expensive to buy a house. Holy cow, there's a woodpecker on the other side of my wall. Need to shoo him away. So like I was saying, for an FHA loan, you have to put 3.5% down. And on a $280,000 house, that would be $9,800. And then you have, he's back. I'm just going to go forward. And then you have a series of other closing costs associated with buying a house. In Pennsylvania, there's a 2% transfer tax. Normally, the buyer pays 1% and the seller pays 1%. In certain circumstances, the buyer may pay the full 2% because, if you're competing, you want to make your offer look good to the seller. But we're going to say they paid 1%. You also have to set up your escrow accounts, which is when your lender, he basically, or she, puts 2 buckets of money aside for you. One bucket collects all the money to pay your real estate taxes. The other bucket collects all the money to pay your homeowner's insurance. So when you pay your mortgage payment, it is made up of 4 things. You have your principal and interest for your mortgage, and then you have your taxes and your insurance. So those buckets are these 2 numbers. So when you are borrowing your money, you have to set up those escrow accounts. So you're setting up money for your taxes and you're setting up money for your homeowner's insurance. The other thing that you will be paying for is a title search and title insurance. In Pennsylvania, real estate changes hands through title. So you will hire a title company or title attorney, real estate attorney, to search the property back 60 years to be sure that you are owning it free and clear. And then they will also issue you a title insurance policy to be sure that nothing was missed. So when you go to sell the house, let's say something was missed and there is a portion of money, there's a lien on the house, something like that, that has to be paid for that new person to purchase it, you are then covered. It's extremely important. Then you have some other miscellaneous fees. You will have to pay for an appraisal since you're borrowing money. You will potentially have to pay your buyer's agent. You and your buyer's agent will sit down prior to buying a house, ideally, and you will sign what's called a buyer agency. That is essentially your agreement to work with a realtor. It's like their employment contract. And you will set the commission that that realtor is willing to work for. So if the seller is not willing to cover all of that commission, then you will have to make up the difference. Okay, so you have your $9,800 and you have this other slew of closing costs. So you're out of pocket for this fictional sort of $280,000 house in York, Pennsylvania. Your total out of pocket for an FHA loan would be somewhere in the area of $25,000. Your monthly payment, which I told you earlier is made up of principal, interest, taxes, and insurance, collectively would boil down to just under $2,500 a month. So if you feel that you can save up $25,000, or you possibly have a family member or friend who's willing to gift it to you, that is also an option. You can also borrow money from your 401k or retirement account. There's different ways that you can collect this money, but essentially you're going to need about $25,000 to buy a $280,000 house with an FHA loan. The taxes on this property were a good bit higher than is normal for this area, so your out-of-pocket could potentially be lower, but just to give you a ballpark, that's what you're looking at, and you would have a monthly payment of about $2,500. Again, if your taxes are lower, you will have a much lower monthly payment. Taxes have a very big impact on your payment. The other thing I should mention with this particular scenario is, with it being an FHA loan, you will have private mortgage insurance for the life of the loan. That is because the government is backing the loan and they want to be sure their money is protected. Had you been using a conventional loan, which is the most basic type of mortgage, you would still be paying private mortgage insurance until you owe 80% or less of your loan to value. So if we're pretending you bought a $100,000 house and then you paid down your mortgage to $80,000, then your private mortgage insurance would fall away. If you feel that you've made improvements or the market has improved greatly and you feel that your house is worth more, let's say you feel your house is worth $120. I don't know how to do that math. I don't know what is $80,000 of $120 right now, but if you felt that you owed 80% or less than $120,000, you could have an appraisal done, and if it appraised for $120, your private mortgage insurance would fall away faster. So a downside to an FHA loan is the fact that you're paying that private mortgage insurance for the life of the loan. An upside is the lower down payment, and you do normally get a lower interest rate. So I hope that was a good summary of where to start and a real life example of how much it would cost you to buy a $280,000 house in York, Pennsylvania. If you have any questions, let me know. Please like this video and subscribe. That'd be great. Okay, guys. Let me know if there's any topics you want answers to.